property is often referred to as the Great Australian Dream, but probably only second to that is owning an investment property. So what are the basics that you need to know and need to understand? The first thing that you need to decide when buying an investment property is what is it that you're actually after. Are you after an investment that can pay for itself and therefore looking for a high level of rental yield? Or are you looking for an investment that perhaps you can afford to lose some of your cash flow to in the short to medium term in the hope to make up for it with longer term gains? Really, it's a play on income versus capital growth. And depending upon where you buy and the type of property that you buy is going to help determine which one of those is going to play out for you. The next thing that you need to decide is how much of your cash flow are you willing to lose to this investment every year. Now, you often hear people talk about negatively, neutrally, and positively geared properties. In very simple terms, a negatively geared property simply means that you're losing money out of your hip pocket every year to keep it running. Some of that loss is subsidised by the Australian Taxation Office by you paying a reduced rate of tax. However, at the end of the day, you're still out of pocket. A neutrally geared property, on the other hand, means that the income that you're receiving in the way of rent is covering the ongoing costs of running that property. And a positively geared property means that the income that you're receiving is actually not only covering its costs, but putting money back into your pocket each and every year. Importantly, it's good to understand which one of these types of property investments and what sort of gearing you actually want when you're buying a property. The second thing you actually need to work out is under which tax environment are you going to buy the property. Are you going to buy it through your superannuation, or are you going to hold the investment outside of super? Whichever way you look at it, investment property is a long-term investment. It's not about buying and flipping the property over quickly. It's about providing you a long-term investment to build your financial security and also build and work towards your financial freedom. If you think about investment properties, they're not cheap to enter into. There's stamp duty and legal fees. And when you go to sell the property at the other end, you have to pay the estate agent. So if you're lucky, 1 or 2 years worth of gains is going to cover those costs. But you really are going to need to hold the property for at least 7, if not 10 to 12 years to enjoy the benefits of a full market cycle. So when it comes to investment property, it's about understanding the type of investment you're after. Is it income or capital growth? Is it an investment that's going to add to your cash flow every year or take away from it? But importantly, making sure that you're looking at the broader picture and keeping an eye on your long-term plans.